All right, we are live. So thanks for tuning into the Everyday Investor. I am your host, Darcy Ungaro. Today we are talking about KiwiSaver, navigating troubled waters. What should the average everyday KiwiSaver investor do at the moment? What shouldn't they do? And I'm joined by two very special guests. Firstly, we have Rupert Carlyon. How are you, Rupert?
G'day, how are you? Good, thank you.
Good. Now, Rupert, you are the founder of Koura Wealth, a KiwiSaver fund manager. So
Yep.
that's correct, right?
Yes, it is.
Fantastic. That's good. And then we have Tom Hartmann. Both of you guys, by the way, have been guests on the show previously, so thanks for coming back. So, Tom Hartmann, you're the managing editor at Sorted. So, thank you, Tom.
Thank you. Hi, everyone. Great to be with you here.
Yeah, awesome. So this is going to be a really, hopefully, pretty casual, chilled out, but informative discussion that we're having. You guys come from different perspectives. We all come from slightly different perspectives, but I suspect that our views on the current events, i.e., the financial fallout, if you like, it's a bit of a strong term, but the financial fallout that we have seen and that no doubt we will see from COVID-19 related stuff will continue to play out, and it'll be a marker in our minds forever. But there's some important things that we should have a discussion of. So straight off the bat, I just want to open up this article here that I've read. Thanks for sharing this, by the way, Rupert. This is an article that highlights the fact that in the month of March, over 1 billion funds have been moved from higher risk investments to conservative options within KiwiSaver funds. So, Rupert, do you want to go first and just tell us what's going on right here in the minds of KiwiSaver investors?
Yes, I think for a lot of people, this was the first time that they had seen their KiwiSaver balances go backwards. And there was a lot of talk in the media at this time about how much further they might fall. Markets were pretty scary, right? We saw a number of days where they were down 8 to 10%. We had 3 days where trading was halted in New York as a result of the markets moving so quickly. And the media picked up on this. People saw their KiwiSaver balances falling. And so the natural reaction from everyone is, what can I do? How can I fix this? And unfortunately, what we saw a lot of people switch out of growth funds into conservative funds through that period to try and protect themselves from further falls. And it was a very, very scary time. And that's clearly why they did it. But unfortunately, for those people that switched, they missed out on that subsequent recovery as well.
Right. They freaked out. They saw the sharp decline, the first part of the V. And actually, talk me through this. I'm curious. So let's say I was invested in a growth fund within my KiwiSaver fund, and I saw this happening. I saw the media. I panicked. I freaked out. I logged into my KiwiSaver provider, and I just filled in the form or whatever, and I moved to a conservative or cash fund. What actually happens? Tell me about the mechanics behind the scenes. What actually happens? How does a fund manager make that change on behalf of a KiwiSaver member?
So all funds are different. All I know is, so our one, so at Koura, what would have happened? You would have gone into the portal. You would have made your decision to change. We then would have processed that change the next day. So the units that you hold in your growth orientated funds would have been sold, and you would have purchased units in the conservative fund that very next day. So it's a very quick process. But the issue around here is you're sitting there thinking, so between 31 December and maybe kind of around about the 20th of March, you would have had a growth fund which would have fallen about between 20 to 25%, depending on where you were. And you would have had a conservative fund which had fallen from anywhere from 0 to kind of 3, 4, 5%.
Yeah.
The issue is that when you sell the units in your growth fund, you're selling them at 25% lower than they were valued back in December. At the same time, that very same day, you're buying units in your conservative fund. So those are a little bit cheaper, but not very much. But then if we roll forward 3 weeks, what happened with the speed of the recovery, all of a sudden those units in the KiwiSaver growth fund were now worth an extra 15 to 20% more, whereas the units in the conservative fund were only worth 2% more. And so what you've effectively done is you've locked in the losses from the growth fund.
Right. So the money, the KiwiSaver member is buying some units in this growth fund. The value of those units drop. They then translate it back into money. Then that goes into a conservative fund. So they've locked in that loss, and then chances are they're going to chase the gains on the way up again. So they'll move it back into growth when the storm passes. And
Exactly.
so yeah, Tom. Actually, Tom, why don't you talk to me about that? So what's going on in the mind of, like, tell me a little bit of the psychology that you think for the everyday person. What are they actually thinking or feeling when they're going into this? Are they trying to outsmart the market, do you think?
Well, this has proved to be a brilliant opportunity for people to really understand what's going on with their KiwiSaver accounts. And Rupert, there's great explanation there. And a lot of people don't understand, even first off, that it's not a savings account, and how a KiwiSaver is an investment account. It acts differently. But we're also, the other thing I'd mentioned, we're in an environment where a lot of people are looking at their KiwiSaver balances. They're getting more attention because they're getting larger, right? And so if they're hovering around $20,000, research is showing that, when it gets to be the size of a small car, what you'd buy a small car for, people pay extra attention on. So, and they're looking at it in real time, and all of a sudden they're seeing this balance, go down instead of up. It's not a store of value as you would with your savings account. It is a store of investments, and those investments go up and down in value, as Rupert just explained. Those units, depending on the marketplace, have the pricing goes up and down. And so they're seeing their balances go down for the first time. I have people writing into us here on Sorted, who are just getting their heads around this. And it feels like somebody reached in there, and very often they'll blame the provider, unfortunately, Rupert, that somebody reached in there and pulled money out. Hey, wait, did the government do that? Did the greedy provider do that? They used my money for something else. And look, when the market recovers, they basically say, hey, did you find some comments? This is on.
Yeah, I just saw this actually, Tom. You obviously get this all the time, don't you? So these are real comments.
Yeah, and so that bottom one, for example, capital letters, don't understand the reason for this is KiwiSavers are losing. And so I spend a fair bit of time on social. Again, this is a great opportunity for us to get people educated about how this works, of just responding to people. Actually, you didn't lose. It's just that your investments were worth more at a given time. And, that'll change. Sometimes I try to explain it, a unit as if you owned a segment of an orange at a supermarket, right? And so you own a segment of an orange. That orange is on a shelf with lots of other oranges, and the price of oranges goes up and down. And when it comes down, the value of that segment that you're holding is worth less. You still hold the same segment in your hand. And then when it comes back up, then the value comes back up and your balance. That's why it's a roller coaster. I mean, that's the other metaphor that seems to resonate with people is that once you've, gotten a strategy in place and found out that you have the height restriction to get on this ride and you strapped into this roller coaster, that pretty much you don't want to try to get off halfway through, and so you're in free fall, right? Which is what people are experiencing for the first time, and then they miss out on the take back up.
Gotcha. Thanks. And I guess it's to use that analogy and to kind of carry that forward. Like, I know last time I was fortunate enough to almost lose my breakfast on one of those rides on the Gold Coast in Australia. It kind of really taught me a lesson, and that lesson was hey, maybe you're not really as into these thrill-seeking rides as you thought you were. so yeah,
very good age.
Yeah, but that's a good analogy for understanding. Hey, sometimes it takes a few twisty-turvy, upside-downy moments to realize who you are as an investor and what your risk profile really is. And typically a younger person, gung-ho, they've got a really small balance, doesn't even buy a car yet. Of course, they're going to be taking a lot more risk, but they actually haven't gone through a downturn yet. And until they do, they're not going to really know who they are. So I guess this one for you, Rupert. I know that when I had you on the show before, that's kind of one of the main selling points of Koura Wealth is actually having that extra tool that you guys put out there to help put people in the right allocation of that fund, the right mix, right? Based on who they are as a person. But you wanted to speak to how important it is, as highlighted by current events, to choose your fund deliberately.
Yeah, so we found it really interesting. We did some research last year and we saw that 53% of people sit in the wrong type of fund. And so that was a big survey that we went out to over 1,000 people with. And then when we went live in the market, what we found fascinating when we started talking to people is younger people would say, oh, you're about to buy a house, so you need to be in a conservative fund. And we'd build them their own personalized portfolio. And they'd go, no, I just want to stick with my growth fund. I've been getting really good returns for the last couple of years in my growth fund, therefore I'm not going to change it. And then we kind of saw a little bit of that happening at the top end as well, where the 60-year-old approaching retirement. And unfortunately, so for us, these are the people that we kind of looked at it through our data, and they weren't really willing, a lot of them weren't willing to take the advice that we were giving them. And unfortunately, we've now had a lot of people come back and say, oh, I can't buy that first home anymore because my KiwiSaver balance dropped by 20%. I've moved to a conservative fund now to protect it, but my house deposit's 20% lower. And I think it really shows, coming back to the analogy, you need to make sure you are at the right height level and that you can get on the right type of roller coaster, because there are real costs to you personally if you don't get on that right roller coaster. For far too many people, I think it was a case of tick the box and don't make any more decisions and never think about it again. The other type of persona that we kind of talk a lot to is it's all about returns. Therefore, I just need to have the highest return possible. And no one had ever thought about risk before, because for the last 10 years, we haven't seen a risk environment. But as I like to say, at the moment, now is the perfect time, is the kind of time where a lot of our clients are very happy that we've managed to put together risk-based portfolios for them. Because as in financial theory, I mean, Tom, you'll be all over this, Darcy is a financial advisor, our job is actually to protect people from the downside, is to give people as much upside as we can whilst protecting them from the downside. And I think consumers kind of forgot about that trade-off. And that's hopefully what we can get people back to in the new KiwiSaver world moving forward.
Yeah, Tom, do you have anything to add to that in terms of some of the lessons, I think, or some of the, I guess, highlights, right? Like current events have highlighted some things. And Rupert, you just nailed one of them right there. But what other kind of lessons should we be taking out of current events in terms of how we look at KiwiSaver and how we view it?
Well, I saw some of the same things that Rupert did. So, I had sorted user preparing to buy a first home in a growth allocation, hadn't moved, and then figured out that maybe, well, luckily in that case they were still able to stay on track towards their goals, but then others no. Then we ran into some other people who came right out of their KiwiSaver fund and realized their mistake, and then wrote in saying, okay, so people are shopping around now, and basically what they're shopping around now is the right level of risk for them. So we really try to, on Sorted, we try to help them out and figure out the type of fund that they should be looking at. So for example, in KiwiSaver, you shouldn't be looking at all, 250 sort of funds. We try to narrow it down to say 30 or 40. So one of those, allocations, even though there's a wide variety within, say, a balanced fund, there can be lots of different kinds of balanced funds, but at least get them started at looking at these buckets of risk. And people are just getting across that for the first time, that it has to be the right. And it's great, Rupert, that it's that kind of roller coaster, because when you go to a park, there are lots of different ones that are built for different things. They're not all the same. And I can remember, my teenagers being gung-ho, going for, a corkscrew one, and then getting off it and realizing, hey, actually, okay, been there, done that, but I don't think I'm going to do that again, sort of thing. But the point really is that you really want people to get to their goals. I mean, Rupert, it's great to hear you say, you're there to protect people from the downside. But what we're here is actually to get people investing and make sure they're on track to their goals. So one way of understanding risk is just that possibility that they might not reach their goals, you know. And so what are those risks there? So it's not just the ups and downs. There are other, you know, that come with industries that, you know, if you think about the airline industry right now, if you're heavily invested in that part of the world, obviously a huge disruption going on there. There's all different kinds of risks that could derail you from getting to what your goal is.
Cool. Awesome. So in terms of, you know, and we've kind of covered, well, figuring out the right type of KiwiSaver fund is sort of a bit of a balance between who you are and the environment that you're heading into. And Rupert, you used the good example of getting your first home. That's an event that's coming up on that trip that you've taken that should be taken into consideration. And then it's also a little bit about who you are. If you're going to be up all night worrying about what the S&P 500 is doing, then maybe you should think appropriately, right? So
yeah, Darcy, with KiwiSaver in particular, it's those two things, right? And a common misconception is that it's about how old you are. Actually, it's not. It's about how soon that you'll need the money. So what's your time frame involved? And you know, for those people that Rupert was describing about who are you know, buying a first home, that happened to be in the near term. Now, if it's 10 years or more out, then that's a different story. You can you know, afford to take on more risk. So those two things, it's really time horizon, how soon do you need the money, and your tolerance, your comfort level risk, whether it keeps you up all night with KiwiSaver.
Yeah, cool. I'm just going to show this up just as a bit of a breakup to our conversation, just to show a bit of a graph here on what that pullback was. This is the S&P 500, and it shows the sharp drop and then the sharp recovery. And we're not going to sort of go into the reasons why and all the rest of it, but it just speaks a little bit to that roller coaster ride, doesn't it? That investing is not a linear path, and it's not something that the everyday person should necessarily gamify and try to win. It's really just looking at the end point and when that end point needs to be real for you and what the start point is. So, you know, how long are you invested in, when you're going to need that money out, i.e. what you should do to kind of align yourself according to the right fund, right? So
I think that chart of yours is really interesting, Darcy, because actually if you zoom in a little bit on that last kind of 2 months, and so I use that chart actually to describe to people why trying to game the market and time the market, it's just so hard, and makes it really hard, because I sit there and I look at, I'm pointing at my screen rather than your screen, but I sit there and I look at the dips and I go, dips. And when a whole lot of professional investors and all the traders around the world thought, okay, we've hit the bottom. So then they went in, so they drive the market back up. You look at the speed of that decline that happened, and then the speed of that recovery. I mean, that was over 3 days, that was 18% up on where it had been previously. And you sit there and you go, to me, actually, just how many ups and downs and how jaggedy that graph is just shows if you're trying to game it and kind of try and pick the ups and downs, it is just so hard.
Yeah. And I think, like, from my perspective, I know for me personally, I like a little bit of the kind of playing around with it a little bit. I find it quite engaging and quite stimulating, but sometimes you have to choose the vehicle that you're playing in really carefully. You don't really want to use KiwiSaver as your vehicle to try to do that. But like for me, I've found it by using one of those trading apps and getting a virtual portfolio on that, so I could actually have a play around. And guess what? I can't figure out how to make any money out of that either. So it just really reinforces the lesson that timing absolutely doesn't work unless you're amazing at what you do, and then you wouldn't be here, would you? You'd be.
Well, I mean, it's interesting. So out of the research, New Zealand's too small, so we don't have it here, but looking at the wealth portfolios over there, the research shows that the average investor will be 4 to 5% worse off by trying to time the market. 4
to 5% worse off. Wow.
5% worse off per annum.
Yeah.
So the kind of timing just means you don't get even close to it, right?
Yeah.
I think there's a reason why fund managers stay pretty invested on the way through. I think you saw some of the more active KiwiSaver managers through this current piece. their asset allocations didn't change much because, as you say, even they don't not that confident in their ability to time it. So they want to make sure they're well invested for that recovery when it happens, but then they'll take the top off, and it's small changes. And I think that's what the everyday investor doesn't quite get.
Yeah. Okay. Do one of you want to talk to me? Maybe Tom, this could be for you. But when there is volatility in the market, like we see right here, when it does kind of go choppy like this, it's not all scary and bad. It's actually kind of good because of this wonderful magical thing called dollar cost averaging. So Tom, do you want to just describe to me how dollar cost averaging works, especially when we're on the way down? Why is that actually not always a bad thing?
Yeah, so this is something that I'd really like to get more out in the open. So I'm really glad you asked this. Is people don't realize that part of the genius of the KiwiSaver system is the regular contributions that are going in. So if you think about it a second, those regular contributions from you deducting from your pay packet mean that when you put money in at a given time, depending on if the market is up, you are buying effectively less units. That same amount of money is able to buy less, but that means you're buying less of things when they're more expensive, which is generally a good idea when you're going around shopping, right? Okay, so when you're putting in those regular contributions and the market has come tumbling down, like we've seen, what's happening there is you're actually buying more. You're buying more units that are effectively on sale. So we've got an automated system going in that actually has you buying more when it's cheaper and less when it's more expensive. This is genius, so that the key is keeping those contributions regular. The experts, and I defer to Rupert if he wants to explain this, call this dollar cost averaging. When you get into a market, you do not want to just go all in at a certain time. You want to spread out your contributions, and so that you pick up both the ups and downs. If it's way too up and it's too expensive in that moment, so you don't drop a lump sum in it. Basically, you keep yourself from buying too much in that moment. If it's all the way down, it just it spreads it out, evens it out, and you get a much better result over time.
And as soon as you've decided to change your fund, you're still dollar cost averaging into the scheme, but you've just sold all your units and you're buying into another unit. So it's kind of like going all in, all at that price. So Rupert, actually, could you just expand on that a little bit more and talk maybe a little bit to the whole kind of, in Australia, we've seen the same thing happen where there's been a bit of an exodus from growth into defensive schemes with their pension over there. And it's you'd think, well, hey, it's actually just the young, uneducated buffoons that do this, but no, it's actually the mature group as well, people who've been invested for a while. Do you want to just talk to that, Rupert, as to why that is and expand on that a bit?
Yeah, so I think, well, there's a few things. One, so Vanguard actually did some really interesting research on this. Vanguard, the largest fund managers in the world. The biggest risk to your investment is yourself, is the kind of their theory, because the human brain is programmed to try and make things better. So when you see something going wrong, you will always do your best to try and fix that problem. And you always think, oh, I can make that a little bit better, or I can do something here. And unfortunately, investing is no different. You see the markets going down, you see your KiwiSaver balance going down, you go, what can I do to fix this? What can I do to fix this? And what that means is that people forget about their long-term plans. They forget about actually, I've set my risk tolerance, I've set my objectives, I've set what I need to do, because all they can do is think about, this is exactly what I need to do now. I liken it to Google Maps, right? So Google Maps always gives you a path and gives you a place to go. The moment that you hit a little bit of traffic on that Google Maps, you think, oh no, I'm better than this. I'm going to go take this back road over here. And almost always...
Yeah, I get that. That really resonates with me.
And it's kind of, it is what it is. And so I think there's 2 points to that. One is there's a psychology around it, but I find the Australian stuff quite interesting as well, because we beat ourselves up here in New Zealand a lot around our financial literacy and how far behind the 8 ball we are in the world. But I think unfortunately, or not unfortunately, but I think what this does is it actually shows we're not that materially different to others as well. Australia's got a pension scheme that's been there since the mid-80s. I mean, you saw in Australia through this, people had to basically deliver digital tools within days because they couldn't handle the phone calls coming in. And as a result, we've seen some of the big Australian companies go, okay, the downturn is what's forced us to say we need more digital advice, we need more digital tools, because we just can't man the phone lines and there just aren't enough people around to help people at a time of crisis. And the role of any provider, in my view, is to help people through a crisis. And to do that, you need to give them great advice and great help in the good times. And then you equally need to be there during the bad times, and having people having to wait an hour on the phone to talk to you is not going to give anyone confidence. And when they don't have confidence, they're going to make silly decisions.
Yeah, so even that long-term experience with a super system is not enough
No.
in Australia, and so we could, 20 years from now, KiwiSaver will be a lot more mature, but there'll be a lot of people, if they don't get the education and don't understand how it works and how it can work for them, then they're going to continue to do this. Just linked to what Rupert was saying, there's also the psychology of loss aversion, which is we feel those losses. I mean, so it is true that you don't want any downside, right? Warren Buffett's rule of investing, don't lose money. Rule number 2, see rule number 1. It's all about, okay, great. You don't want to, but the fact is that psychologically we feel those losses about twice as much. Psychologists tell us twice as strongly as we do gains. And so we want to run exactly this is, due to our survival mode, of the species. It's easy to understand. But however, when you mix that with investing, you get some behaviors that really do ourselves financial damage.
It's a multi-pronged solution, right? We've got the analog advisor like myself, speaking advice one-on-one to people, or as many people as I can get in front of. Then you have initiatives like Sorted out there, starting with the schools all the way up to retirement, putting out best practice out there. And then you mentioned it before, Rupert, there's the onus sits also with the providers to provide advice, and you guys are really good on the digital front. I've just got a good question here from Zeke on the Facebook channel here. He wants to know if robots will one day take over from humans. And I guess what he's getting at here is, will there be a transition where someone like myself will be replaced by a robot in terms of giving advice? And is that just around the corner?
This is a passion of mine, as you'd expect, being a robo-advice provider. Personally, I don't think you and personal advisors will ever be replaced. There will always be a role and a place for good quality advisors to talk to clients, to give them high quality advice and give them comfort, right? Let's be honest. Number one role of an advisor is giving people confidence in the decisions they need to make. And you being able to sit down with someone and explain things clearly, succinctly, and in a great way, which I'm sure you do, will always be necessary. However, we also need to be cognizant that there is a significant part of the population that at the moment can't get access to advice. Let's kind of be brutally honest. KiwiSaver is a product where you've got average balances around $20,000. People are unwilling to pay for advice. If you're going to book an advice session with an advisor, that might cost you $200 to $500.
At least, Rupert.
At least. Right?
No, I'm just kidding.
The advice is too expensive, right? And so there is a massive part of the population that can't get advice at the moment. And that's the part of the population that robots and computers need to serve. And at the end of the day, KiwiSaver is a product which is fairly simple. As Tom said, we need to understand your risk appetite, which we can do through 3 or 4 pretty simple questions. And we need to understand your objectives. And actually, a computer can build you just as good a portfolio as the personal advisor. However, they can't give you the empathy, or they struggle to give you the empathy and the explanations that a personal person is going to get. So I think there will always be a world where there's both. the personal and the digital, and it's about figuring out what works for each individual person.
Yeah, good answer.
The thing I'd add to that is, in this work, I've really become much more aware of how different people are. And there's not just a psychological profile, but their financial circumstances. And so we like to talk about KiwiSaver a lot, but KiwiSaver in someone's portfolio is just part of their portfolio, right? So they own lots of other things, maybe a house, maybe investment property, maybe, even savings account, cars. There's a whole bunch of moving parts. And so I don't really see financial advisors being needed less, but there are some things that we can automate really well. Like, the more automatic some of these things are, like regular contributions, means that it's going to work that much better, right? Mm-hmm. So once upon a time, you might have had to go down to, an investment house and actually fork over cash in order to invest once upon a time in the past. Now we can do it automated. It doesn't take away the need for advice, but that does ensure that certain things do work better. And so, being able to automate a portfolio, I'm all for that, but you are going to need people to interact with people and make sure that the tools that we build are really working for them.
Yeah, well said. Okay, so if I was to sum this up, really, I guess what we're saying here with respect to KiwiSaver in the light of this post-COVID-19 world that we're heading into, the more that you fiddle with it, the more you're going to get in trouble. Is that a fair comment?
There's more opportunity for error. Yeah.
Unless you're a freaking genius, right? Then good on you. But really, it's not the right tool for you to be changing lanes in frequently. There's a little bit more to it than that. So, is there anything?
Darcy, it's something that shouldn't be looked at every day. It's something that probably shouldn't even be looked at every month.
Yeah.
But it is something that you do need to look at on a regular basis. So we say every 6 to 12 months, because as a person, you change. So we need to make sure that people don't treat it as a set and forget product, because fundamentally you will get closer to your retirement. You will get closer to buying your first home. Your appetite for risk will change. And so you do need to continually review to make sure you do have the right settings. Yeah. However, I do think it's worthwhile deleting it from your banking app. And wake up every morning and have a look at it. That is going to cause you nothing but stress, and also cause you to think really hard about, actually, do I need to do something to fix it?
It's a good point. To a certain
extent, with KiwiSaver, ignorance is bliss.
Yeah, I often find that when I'm talking with clients of mine that are, say, for example, they want to get debt-free faster, and they're looking for ways of structuring their mortgage to get out of debt much faster, and they want to overpay over a period of time, one of the number one most popular and effective tools that I often see employed is removing the mortgage from your main bank and placing it with another bank. And it speaks exactly to that point, that the less visible something is, ironically, the better you behave with it. And I guess there's a fine balance, right? That if you are constantly looking at your KiwiSaver balance and fixating on the fact that it went down 10% last night, and, oh no, what am I going to do? Of course, you're going to be tempted into fiddling with it too much. But on the flip side, what I really got out of our podcast that we did a while back, Rupert, was the importance of actually reviewing it. Because on the flip side, there on the other end of that spectrum, there are probably too many people that are completely ignorant about not only how KiwiSaver works, but why they should have proactively chosen their fund. They just don't play that game. So it's probably, I don't know what the magic number is, and it's probably different for everybody, like everything else, but 1 or 2 years, you should at least be looking at it in terms of the overall strategy, but not necessarily with the intent to make changes.
Yeah, it's easy to understand why that is when you, back to that chart that you were showing us, those ups and downs. So if you can see your balance on your app, you're going to see those downturns that much more often. There's a higher chance that you're going to see your balance falling, right? So if you check in once a quarter, once every 6 months, or once every year, the number of times that you're going to see your balance fall, even though it does that on a regular basis, is far less. It might be half as much, for example. So there's a far less chance of you panicking, reacting, trying to fix something, as Rupert says, it's really true, and
Yeah.
therefore meddling with it. So that what we need is this funny balance of being engaged with your KiwiSaver, but also not looking very often. And the answer is those regular reviews, which goes back to that need of, for advisors for that. People, if we could automate this, it would be great. Automate a regular review. And I think in the future we might
I hate to say it, Tom, but that's exactly what we've done. We do
nice.
reviews. So automated annual reviews is what we do for all of our clients. And
actually,
the other beauty about annual reviews is we don't, and because we build each individual portfolios, what we don't do is we go a big jump from growth to balance to conservative. So we'll change you 1 or 2% allocation every year. So it doesn't really matter what the market's doing when you're doing it, because we're making lots of little changes. So coming back to that point that you raised earlier, Darcy, around rather than trying to change everything at once. But that's what technology allows us to do. You talk about the technology allowing us to put in weekly, and actually technology allows us to do all of these things and replicate a lot of the services that personal advisors do now.
Awesome. Cool. Okay, so before we finish up, guys, is there anything else that you'd like to, say to the everyday investor out there with respect to their KiwiSaver at this environment? Tom?
I think the main thing is, to really set your strategy, set your investment strategy in so it's aligned with your goals, whether it's for a first home or for retirement, and then find the right type of fund for you. And that can be done, on sorted. We'd invite you to look at the entire market. So if you're shopping for balanced funds, to know all of them out there. I'm happy to say, for example, that Koura's offering is on our Smart Investor platform, so you can see how they stack up. And then after you settle on a provider, you go and talk to them directly and see what they have. But you're making sure that you're picking the right type of fund for you, the right risk level, and then working directly with the provider on what they offer.
Awesome. Cool. Rupert, anything else that you want to add?
No, I mean, Tom's dead right. Figure out your objectives, your risk tolerance, set your strategy, and stay brave. Don't react, and just stay brave through these tough times. Yeah.
Stay the course, head to the eye of the storm, and she'll be all right.
Great advice.
Yeah. Cool, guys. All right. Now, I really appreciate both of you coming on the podcast today, and wish you all the best. Looking forward ahead into the next few months, it'll be some interesting times. No doubt there'll be a few trends that we can comment on shortly. But I really appreciate the time that you've taken to join me on this episode. Thanks very much, guys.
Thank you.
Thank you. Great to be with you.
All right. Thanks, guys. See you later. Cheers.
Bye-bye.